Welcome back to the deep dive. Today, we are turning our attention to the retail world. And honestly, if you've been following the headlines for the last 2 years or so, retail usually comes paired with words like apocalypse or supply chain nightmare.
Yeah, or just general panic. I mean, it has been a really rough ride for a lot of players out there. You've got legacy department stores closing down, brands filing for Chapter 11, and executives basically sweating bullets on these earnings calls.
Right, trying to explain why nobody wants to buy their full-price sweaters anymore.
Exactly.
It just feels like the whole industry is constantly bracing for impact. But today we are looking at a company that seems to be operating in just a completely different reality. We're digging into the Q4 2026 earnings report for the TJX companies.
Right, the parent ship. So we're talking TJ Maxx, Marshalls, HomeGoods, Sierra, and for our friends across the pond listening in, TK Maxx.
And the contrast here is just staggering. I mean, you have the rest of the industry complaining about inventory gluts and shrinking consumer demand, and then you have TJX, which literally just crossed a massive financial milestone.
They really did. And the mission for this deep dive is to really unpack how. Like, how is a brick-and-mortar, off-price retailer not just surviving in 2026, but, as their own management put it, actively playing offense?
Playing offense. I mean, that's a bold phrase when most of your competitors are just trying to keep the lights on.
Yeah.
So we are going to look at three big buckets today. First, that $60 billion revenue milestone, what actually drove it. Second, the treasure hunt mechanics. We really need to talk about this glut of merchandise and how they get their hands on this
The
stuff.
secret sauce. Yeah, the buying organization is really the engine room for all of this.
Right. Third, we have to talk about shrink, theft. It's basically the retail boogeyman right now, the thing everyone blames for poor performance. But TJX has a very different story to tell there.
It's a fascinating case study in operational discipline, for sure.
But let's start with the scoreboard. The numbers came out February 25th, 2026. Give us the headlines.
In a word, outstanding. I mean, they beat expectations across the board. If we look at the headline numbers for the fourth quarter, their consolidated comparable sales or comps were up 5%.
And just to pause right there, for those of you who don't spend your lives reading retail earnings, comps means sales at stores that have been open for at least a year, right? So we aren't counting new store openings or just the sheer size of the chain expanding.
Precisely. It's the absolute best metric for organic health. If you just open 100 new stores, your total sales go up automatically, but your actual business might be rotting from the inside. Comps tell you if the actual customers are coming back to the existing locations, and a 5% jump in this maturity phase, that beat the company's own internal plans significantly.
Okay, so existing stores are definitely busier, but the big number I saw was the full year revenue.
Yeah, the big six. Oh, for the fiscal year ending January 2026, net sales surpassed $60 billion. That is a first in the company's entire history. To give you some context on that, it puts them well above the likes of Nike or Macy's in terms of sheer revenue volume.
There's value.
They are a titan.
And looking at the bottom line.
Yeah.
Because, revenue is vanity, profit is sanity.
Right. Well, adjusted earnings per share, or EPS, for the fourth quarter came in at $1.43. That's a 16% increase compared to the previous year. So they aren't just selling more stuff. They are actually becoming more profitable while doing it.
That's the trick, isn't it? Selling cheap stuff is easy. Making money on cheap stuff is really hard. But was this just, one lucky division carrying the team? Like, was it just Marshalls having a great quarter while HomeGoods dragged the anchor?
No, and that's the sign of a really healthy ecosystem. This was consistent. Every single division, Marmaxx in the U.S., HomeGoods, TJX Canada, and the international division, they all posted comp sales growth of 4% or better. It wasn't lopsided at all.
That consistency is pretty rare.
Mm-hmm.
Now, I do have to play devil's advocate here for a second. When we say sales grew, is that just because of inflation? Because I feel like I'm paying more for literally everything these days. If they just jacked up ticket prices by 5%, that's not really growth, is it? That's just passing the buck to the consumer.
That's the exact nuance the analysts always look for. Was it ticket or transaction? And for TJX, it was both. They did see an increase in the average basket. So yes, people are spending more per trip. But crucially, they also saw an increase in customer transactions.
So more actual bodies walking through the door.
Exactly. Foot traffic is up. That means they're actively stealing market share from other retailers. And interestingly, the CFO noted that sales were actually trending even higher before some winter storms hit North America late in the quarter. So the underlying demand might be even stronger than that 5% suggests.
That is wild. Okay, so the numbers are great. But let's get to the how. Because TJX is an off-price retailer, their whole pitch to you is that they sell brand name stuff for 20 to 60% less than department stores. In an economy where inflation is still a real thing and supply chains are messy, how do they keep prices low but push their margins up?
This brings us to their buying organization. And honestly, this is the part of the business model that people misunderstand the most. We aren't talking about a few people sitting in a corporate office ordering from a seasonal catalog.
Right, they don't just call up Ralph Lauren and say, hey, send us the usual fall collection.
Not at all. They have over 1,400 buyers.
1,400, that's not a buying team, that's a battalion.
It really is. And they are sourcing from a universe of approximately 21,000 vendors globally. And here's where it gets really interesting. The CEO, Ernie Herrmann, used some very specific language in this report. He described the availability of merchandise in the marketplace right now as outstanding and off the charts.
Off the charts. I mean, that sounds good for them, but what does it actually mean in practice? Is there just too much stuff being made?
Essentially, yes. There is a glut of goods in the marketplace.
A glut.
A massive glut. Think about the last few years. You had supply chain shortages, so brands over-ordered to compensate because they were terrified of running out of stock. Then demand cooled off or consumer tastes shifted away from certain categories really quickly. Now, high-end brands, manufacturers, department stores, they are all sitting on mountains of excess inventory.
And that's where TJX swoops in.
That is exactly where they play offense. Unlike a traditional retailer that has a rigid must-have list, like we knew exactly 5,000 red sweaters by October 1st, TJX buyers are completely flexible. They are opportunistic. They have what's called open-to-buy dollars.
So they don't go in with a shopping list.
No. They go in with a checkbook. They walk into a vendor who is panicking about a warehouse full of cashmere scarves that didn't sell at Nordstrom. The vendor needs cash, and they need that inventory gone yesterday. TJX says, we'll take it all, but we're paying 40 cents on the dollar.
And the vendor says yes, because
TJX pays. Management really emphasized this. Vendors want to deal with them. They are known for being fair, and very importantly, they pay on time.
Cash is king.
Especially when interest rates are high. If you're a vendor sitting on dead stock, holding it actually costs you money. You have warehousing costs, insurance costs. TJX effectively acts as the liquidity provider for the whole retail industry.
That's a great way to put it. They are the clearinghouse for everyone else's mistakes.
Yeah.
But there's a silence to it, right? I imagine Gucci doesn't really want to advertise their selling to TJX.
Correct. That's part of the deal. TJX protects the brand's image. They take the goods, they mix them into the rack so there isn't a giant clearance sign on that specific luxury brand, and the brand gets their cash quietly.
And they turn those market inefficiencies right into their margin opportunity. The CEO mentioned that this buying environment allows them to acquire better goods. So they aren't just buying junk, they are buying higher-tier brands than they might normally get because those high-tier brands are overstocked too.
Exactly. You walk in expecting a generic brand and you find a high-end Italian label tucked in the rack. That just reinforces the whole treasure hunt aspect.
Which brings us perfectly to the shopper, because for a long time I think there was a stigma that discount meant low income, or that you only shopped at Marshall's if you couldn't afford the regular mall. But looking at these reports, that doesn't seem to be the case anymore at all.
Not at all. In fact, the demographic data from this report is fascinating. They are attracting a very broad range of income levels. They specifically mentioned they're doing incredibly well with shoppers both below and above the $100,000 household income mark.
So the six-figure earners are digging through the racks just as much as anyone else.
It's almost a badge of honor now. The smart shopper aesthetic. It's chic to be frugal. But the key insight for their long-term growth is actually age. Their customer base is skewing younger than the general population. They are seeing an outsized number of new customers in the 18 to 34 demographic.
Gen Z loves the Max.
They really do. And I think we have to look at the psychology there.
Is it just because things are cheaper?
Mm-hmm.
Or is it the whole haul culture on social media?
It connects right back to that treasure hunt experience. For a generation that grew up with endless algorithmic scrolling on TikTok or Instagram, everything online is curated for you. It's predictive. It's almost too easy. But the physical act of digging through a store and finding a unique item, something that might literally not be there tomorrow, provides a dopamine hit that online shopping just lacks.
It's gamified shopping. You feel like you won against the store.
It is. It's the thrill of the find. And management said they are playing offense to keep these exact people coming back.
What does playing offense look like on the ground? Are they just running more TikTok ads?
It's pretty aggressive. They are ramping up marketing. They even had campaigns linked to the Olympics, which is a massive, massive spend. But they're also investing heavily in the physical stores themselves. They have about 540 store remodels planned just for fiscal year 2027.
That is a lot of fresh paint.
It is. They want the shopping environment to feel fresh, not dusty or dated.
Uh-huh.
If you want to keep that high-income shopper, the store can't look like a rummage sale. It has to look like a boutique, even if the prices are discount.
There was another shift in consumer behavior they noted that I found super interesting, and that was gift giving.
Yes. This is a subtle but really important shift. They are seeing TJX stores become destinations for gifts year-round, not just at Christmas.
Which makes sense. I've definitely run into Home Goods to grab a candle or a fancy throw blanket for a housewarming party at the last minute.
Exactly. Because they carry such a wide mix, good, better, and best brands. Shoppers are confident they can find a cool gift there without breaking the bank. It creates a secondary reason to visit the store beyond just, I need pants.
Speaking of Home Goods, we really need to talk about that division specifically, because during the pandemic, everyone bought furniture. We all redecorated. Then that market crashed hard. So how is Home Goods holding up?
Surprisingly well, they just crossed a major milestone of their own. Annual sales surpassed $10 billion.
$10 billion just in home decor. That is massive.
It is. And their operating margins improved significantly, hitting 12%. And this is partly because they are capitalizing on market share left behind by other home retailers that have closed or struggled in the last few years.
RIP Bed Bath & Beyond.
Right. The landscape is really cleared out. Pier 1 is gone. Bed Bath is gone. Home Goods is just picking up all the pieces.
Now, we can't talk about retail operations without talking about shrink. For the last 2 years, every single time I read a retail earnings report, Target, Walmart, CVS, it's all about theft. Organized retail crime. Locking up toothpaste has been a nightmare for the industry.
It has. Margins have been absolutely decimated by it across the board.
So how is TJX handling it? Are they locking up the candles? Because, frankly, if everyone else is struggling, I'm a little skeptical that TJX has magically solved crime.
It's a fair skepticism, but the numbers don't lie. TJX reported that their shrink is essentially back to pre-COVID levels.
Wow. That seems to buck the national trend completely. Why? Are they just incredibly lucky?
Luck plays a small part, but the CFO credited this to a laser focus on store safety and execution. It actually improved their margin benefit by about 20 basis points.
20 basis points is real money when you're doing $60 billion in sales.
Huge. And think about the structural differences of their stores. In a TJ Maxx, there is usually only one entrance and exit. The checkout line snakes through a queue that is highly visible. You have to walk past 50 impulse items and a giant cashier bank just to leave.
That's true. You aren't using a self-checkout in a dark back corner.
Exactly. There's very little self-checkout. There are a lot of employees on the floor constantly restocking because the inventory turns so fast. Human presence is a major deterrent.
Right. The treasure hunt model means employees are always out there moving stuff around, not hiding in the back room.
Precisely. And also, think about the actual merchandise. It's much harder to fence a unique random assortment of goods than it is to fence standardized commodities like razor blades, batteries, or laundry detergent. Organized crime likes predictability. They want to steal 500 units of the exact same item to resell on an online marketplace. TJX is chaotic by design.
So the chaos actually protects them. That's brilliant.
It seems so, and that preserves the shopping experience for you. You can't have a treasure hunt if you have to ask an employee to unlock a plastic case every time you want to look at a pair of socks.
Me.
They've managed to secure the store without making the customer feel like a criminal.
That is a really great point. Okay, so they crushed 2026. What is the plan for fiscal year 2027 and beyond? Are they taking a victory lap or are they pushing the gas?
Oh, they are definitely pushing the gas. The guidance for FY27 is solid. They are planning for another 2 to 3% growth in comparable sales.
Isn't that a bit conservative given they literally just did 5%?
TJX is famously conservative with guidance. They hate missing expectations. They like to underpromise and overdeliver. But the big news isn't the percentage, it's the physical expansion. They plan to open about 146 net new stores, which will bring their total store count to over 5,300.
That is a massive footprint. Are they opening anywhere interesting?
They are entering a brand new market, Spain. They are opening their first stores there this spring.
Hola, TJX. That's a big move. Europe has been pretty good for them so far, right?
It has. TK Maxx in Europe is a powerhouse, particularly in the UK and Germany. Expanding into Spain is a very logical next step to capture more of that European market. But it's not without challenges. European labor laws, real estate, it's a completely different beast. But if their UK success is any indicator, they have the playbook down.
Now, looking ahead, there is one big macro cloud hanging over everything right now, and that's tariffs.
The elephant in the room.
Right. With the geopolitical situation the way it is and new rulings coming out, isn't that a massive risk? TJX imports a ton of stuff. If a 10 or 20% tariff hits, doesn't that just blow up their whole low-price model?
It is a risk, and management openly acknowledged there is uncertainty there. However, and this goes right back to their business model, the expert view is that TJX handles this better than almost anyone else.
Why is that? I mean, if costs go up, costs go up.
Two reasons. First, the gap. TJX prices its goods relative to the department stores. If a tariff hits, the department store raises the price of a sweater from $100 to $120. TJX raises theirs from $50 to $60. The gap, the actual savings for you, is still there. The value proposition holds up.
Okay, that makes sense. You're still cheaper than the alternative, even if the baseline moves.
But the second reason is even more interesting. Tariffs create confusion. They disrupt supply chains. Brands might cancel orders because they suddenly can't afford the new duties, or they might shift manufacturing abruptly from one country to another.
Which creates
Disruption, delays, and stranded inventory.
a glut.
A glut. And we know they love a glut.
So if tariffs cause chaos for everyone else, TJX just walks in and buys the stranded goods.
Exactly. Market confusion often leads to better buying opportunities for TJX. If a brand can't afford to import its goods or get stuck with them sitting at a port somewhere, TJX can buy them domestically or negotiate a killer deal. So while they are monitoring it closely, they essentially view volatility as an opportunity.
That is the ultimate retail jujitsu.
Yeah.
Just using the market's pain against itself.
It really is.
And for the shareholders listening, what's in it for them besides just the stock price going up? Are they sharing the wealth?
They're very committed to returning cash. They plan to buy back between $2.5 and $2.75 billion in stock over the next year,
Taking shares off the table.
which boosts EPS even more. Plus, they announced a 13% increase in the quarterly dividend.
A 13% raise is nothing to sneeze at.
No, it signals a ton of confidence in their cash flow. They ended the year with $6.2 billion in cash on hand. They have a fortress balance sheet right now. They don't have to borrow money to grow, which in a high interest rate environment is a massive competitive advantage. While everyone else is paying interest, they are paying dividends.
It really sounds like they are firing on all cylinders. So let's wrap this up. If we boil this all down, what is the big takeaway from this earnings report?
The big aha moment for me is that flexibility wins. In a rigid market where everyone else is stressed about supply chains, demand planning, and perfect forecasting, TJX's ability to be flexible, to just buy what's available and sell it to a broad demographic is the winning formula.
Be like water.
Be like water. They are turning an inventory glut into a margin opportunity, and they are doing it while capturing a younger audience that historically ignored them.
It's impressive. They've managed to stay relevant and highly profitable by basically being the smartest scavenger in the room.
And the so what? For the listener, is that the physical retail experience is definitely not dead. We spend so much time talking about Amazon and e-commerce taking over the world. But TJX proves that people still want to go out and shop, provided the value proposition is real. The physical treasure hunt is resilient.
It really is. But before we sign off, I want to leave you with a thought. We've talked a lot today about this glut of goods. TJX's availability is off the charts.
Right.
If there is that much excess inventory floating around the world, what does that say about the wider economy? Did manufacturers massively overproduce?
Yeah.
Is demand for full-price goods just falling off a cliff?
That is the multi-billion-dollar question. If the glut is really that big, it implies the primary market is broken.
Because if the only person making money is the one selling the leftovers, that might mean the main course is in serious trouble. And if we're heading into a cooling economy, is the off-price model the only safe harbor left in retail?
If the glut persists, TJX wins, but it might mean the rest of the manufacturing world is in for a very bumpy ride.
Something to mull over the next time you're digging for a bargain at Marshall's. Thanks for joining us on this deep dive. We'll catch you on the next one.